The night the world's biggest crypto crash happened, on May 19, 2022, the world watched in disbelief as $73 billion evaporated from the global economy in less than a day. By sunset, the algorithmic stablecoin Terra USD and its sister token Luna had vanished, and investors who had poured their life savings into the promise of a decentralized financial utopia saw it all evaporate in a single, gut-wrenching heartbeat. Terra's meteoric rise began in 2018, when a small team of engineers in Seoul, led by a charismatic entrepreneur named Brian Armstrong, not to be confused with the founder of Coinbase, launched a platform promising to unite the fragmented DeFi ecosystem with stablecoins pegged to real-world currencies. In 2019, they recruited a charismatic yet enigmatic figure from Latvia, Eric Stenholm, to serve as their chief technology officer. In 2020, they partnered with a Singaporean fintech startup to create a revolutionary stablecoin, anchored not on fiat reserves but on a dynamic, algorithmic system that used a second token, later christened Luna, to absorb price fluctuations. Enter Do Kwon Terra, better known as Satoshi Nakamoto's spiritual successor, Do Kwon. Born in 1990 in Hokkaido, Japan, to a Korean family, he grew up with an avid interest in cryptography, earning accolades for his early work on privacy-preserving protocols. In 2017, he co-founded a fintech startup in Shanghai that specialized in blockchain analytics, but it was his charismatic pitch in a small conference room in Seoul that secured him a seat at the Terra table. Leveraging his reputation as a brilliant coder and his charisma, he convinced the founding team that an algorithmic stablecoin could outcompete traditional fiat-backed counterparts, promising unprecedented returns. In 2020, Terra raised $32 million in a seed round, attracting heavyweight investors such as Polychain Capital and Andreessen Horowitz. By early 2021, the price of Luna surged from under $0 to $120 per token, and Terra's market cap topped $50 billion. The media lauded Do as the visionary behind a new form of money that would democratize finance for the masses. But beneath the glossy press releases, concerns were mounting. Critics warned that the stability mechanism depended entirely on market confidence. If investors fled, the peg would collapse, leading to a cascade of forced sales of Luna. Warnings fell on deaf ears as the hype machine roared louder. The fateful day arrived on May 9, 2022, when a sudden drop in U.S. Treasury yields sent ripples through the crypto market. Traders began liquidating large positions, and the algorithm governing Terra USD's peg could not keep pace. Within hours, the price of USD fell below $0, prompting a cascade where holders exchanged Luna for Terra at a loss. Within 48 hours, the market cap of both tokens collapsed, erasing $50 billion from global markets and wiping out the savings of countless individuals across Asia, Europe, and the United States. Legal fallout followed swiftly. By June 2022, the U.S. Securities and Exchange Commission opened an inquiry into possible securities fraud, alleging that the Terra project's disclosures were misleading and that investors were misled about the risks of a purely algorithmic system. The UK's Financial Conduct Authority followed suit, and multiple class action lawsuits were filed by aggrieved investors across multiple jurisdictions. Do, who had been traveling between Asia and Europe, vanished from public view in early 2023. Interpol issued a red notice, and the Interpol notices were matched with a report from a French intelligence agency that suggested he was hiding in Montenegro under an assumed identity. In August 2023, authorities in Montenegro apprehended him at a train station after a tip from a former associate. The subsequent legal battle over his extradition became a media circus. The defense argued that extradition would violate his human rights, citing alleged mistreatment in detention facilities. Nevertheless, after months of hearings, a German court approved his extradition to the United States in March 2024. The trial began in the summer of 2024 in New York's Southern District of New York, presided over by Judge Eleanor O'Connell. The prosecution painted a vivid picture: a charismatic businessman who knowingly misrepresented the safety of his product, who concealed internal communications acknowledging the product's inherent volatility, and who used deceptive marketing to lure unsuspecting investors. The defense countered with arguments about the nascent nature of decentralized finance, claiming that the collapse was a market risk inherent to all crypto assets and not a result of intentional fraud. After months of testimony, expert witnesses, and intense cross-examination, the jury deliberated for 12 hours before returning a verdict. The court found Do guilty on 3 counts of securities fraud, 1 count of wire fraud, and 2 counts of money laundering. In his sentencing hearing in January 2025, Judge O'Connor imposed a 12-year prison term, ordered restitution of $150 million, though acknowledging it would be impossible to fully compensate the widespread losses, and levied a $500 million fine to be paid to the U.S. Treasury. The aftermath of the trial rippled through the crypto world. Exchanges tightened their listing criteria, and several jurisdictions introduced stricter regulations for decentralized finance platforms. Institutional investors, rattled by the high-profile case, pulled back from speculative crypto projects, prompting a shift towards more regulated blockchain solutions. Meanwhile, the victims of the collapse have formed advocacy groups pushing for better investor protection and greater transparency in digital asset markets. Do's conviction sent a powerful message: charismatic visionaries are not beyond the reach of the law. Subscribe to the verdict for more stories like this.